investment. Well, joining me tonight to give their opinions is Rob Southwell, Managing Partner of the Sydney office of Pitcher Partners, Chartered Accountants and Business Advisors. And, of course, we've got Tom Panos, Head of Real Estate Advertising at News Corp. So, Rob, welcome to the show.
Thanks,
Always
Chris.
good to get a virgin on the show. Tell us a bit about Pitcher Partners.
Pitcher Partners are a national association of 6 advisory firms around the country. We employ about 1,200 people. One of those preeminent offerings that we have is in the area of private clients, helping families structure their investments, and we also manage about $5 billion worth of assets around the country as well.
Sounds good. So plenty of property investing clients in the mix?
Yep, absolutely. Everybody's in love with the Australian dream. So.
Yep. Sounds good. Now, obviously, when it comes to structuring, I guess what's the most common question? Because normally they're going to come to an accountant rather than probably a lawyer when it comes to structuring. Absolutely.
I mean, the most common question is, how should I buy it? Usually, sometimes they ask me before they buy it, which is helpful. But there's a range of combinations there, and it's probably more of an art than a science. You get questions from your client wishing to build a portfolio of investment properties, but you also get many questions around, people buying properties for their children, through to commercial property, through to developing. So there's a whole range of options there. And again, there is a myriad of iterations that you need to balance out to try and find the best outcome for the client.
So is there ever a perfect thing? Because quite often you get property investors saying, oh, you've got to have this, or my accountant said you've got to have that, or is it dependent on your circumstance?
Absolutely. I mean, it'd be sort of nice to have a perfect solution, but it's very rare that you do get one. It's very dependent on the client's situation, and every client's situation is different, and everyone has different objectives. So you've really got to sit there and understand what the client wants to do and try and get the best balance for the client.
Now, Tom, you used to be a real estate agent and all now. Do you get these kind of questions? Because I gather you used to study accounting in the old days. Well, so would you call yourself an expert?
I'm not an expert, but it's funny, as I'm listening to this conversation, I have to tell you, the last purchase I did an investment, which was about a year ago, on the Saturday, just before I was about to sign the contract, it was a post-auction property, and with auctions there's no cooling off period. I was ringing around my accountant like at 8 o'clock at night on a Saturday night to try and find out what I should actually write on the contract, because if you write the wrong entity on the contract, it's very hard to actually go back after the contracts have been exchanged,
So the land tax man wants a couple of land taxes, doesn't he?
Absolutely.
Stamp duty,
Stamp duty. So all I can really say is that I wish I'd had the conversation not at 7 o'clock on a Saturday night while my accountant was at a restaurant. He didn't appreciate it either, for me to try and work out what's the best structure for the next 10, 15 years. So I actually think people should actually explore that early on in the process.
And you can probably have 2 different price ranges for clients, a Monday to Friday 9 to 5 rate and an out of hours rate.
Absolutely. I mean, people talk about penalty rates on the weekend. Yes, absolutely.
So I guess what are the main factors that people really need to take into account, or at least have the discussion with the accountant?
I mean, there's probably 4 or 5 main ones. I think the first one you need to consider, well, I consider it, try and understand, is what are you trying to do? What's the objective of what you're trying to achieve? Because if you get that wrong, or you don't understand that, you can put a structure in place that doesn't suit the client. And that, again, could be like, well, I want to build a portfolio of investments over a long period of time. A classic example there is you might start with an individual or a couple of individuals holding a property together, and as you build that, then you start looking at other structures together, because obviously as you add structures, such as family trust or self-managed super fund, it becomes more complicated. So I think probably the next issue, which is what most people get concerned about, is the income tax considerations. So you want to make sure, if you've got a positively geared property, you don't want to have them, the person paying the most tax in the family owning it, or through a trust. If you've got gearing, you want the opposite. So, you've got to really consider all of those. And, of course, you've got to consider long-term capital gains tax implications. So accessing discount CGT rates for individuals and self-managed super funds as well. For a lot of our clients, asset protections are really important. So, if you want to try and build assets, but again, you might be in a risky industry, you might be a lawyer, for example.
Or in the media.
Or in the media. I'll leave that one to you. You really need to understand what's the client's are they risk averse in relation to that as well? And other aspects like land tax, for example, which we might get to later on, is a lot of people don't appreciate you can end up paying more land tax than you might have otherwise done had you got appropriate advice as well. And then finally, the commercial decisions that come with that. So what are you trying to do? For example, when you're developing a property, it brings different aspects, as well as dealing with banks as well. So then if you want to move to saying, well, I want to build a portfolio, you're looking at, can you cross-securitise those properties to build it? For example, if you buy into a self-managed super fund, it's very hard to leverage off that property. So you've got to really understand all those aspects and try to put together something that ticks most of those boxes.
Even for us that studied accounting, we're obviously not practising accountants like Rob. I mean, you talk seminars about sometimes the cheapest agent can be the most expensive agent.
Yeah.
I would have thought the same would probably go for property as well, wouldn't it? When you're trying to get advice on what to structure, then cheapest isn't always the best.
Absolutely. I mean, we're just hearing here that there are structures and things available that could potentially save you land tax, which I think a lot of people don't equate. I think a lot of people on the surface, when they're looking at Chris to get advice, they see it as being a bit of a cost. But I think what you've got to look at is then to you.
Because when you're selling the property, that's when you've made the... Because that could be the difference between paying hundreds of thousands of tax or millions versus maybe tens of thousands.
Absolutely.
And Rob, just quickly on the discretionary trust. So that's where sometimes called a family trust. So then the trust has discretion whether it gives it to, say, a husband or wife or kids, depending on their tax position.
Absolutely. So a discretionary trust is called a discretionary trust because you, the trustees, have discretion as to where the income goes. So a trust holds an asset or a group of assets on behalf of a group of people, and none of those people have a direct interest in that property. So obviously that gives you a benefit in asset protection because you don't physically own it. But the biggest advantage is, at the end of the day, is the flexibility. So year on year, depending on what your circumstances are, you can stream income to the family member or other entities in your structure that can utilise the lower tax rates to come with that. So they're probably the benefits. I think you've also got to be mindful of the disadvantages. So, for example, if you're negatively gearing in a trust, you can't access that loss, which is what happens when you negative gear. So you've got to make sure that you've got other income coming into the trust to make sure you can absorb those losses as well. And then we talked about land tax. I think a lot of people don't appreciate that, you know, as an individual, for example, in New South Wales, you get a threshold, I think it's $482,000 for this current year for an individual. A discretionary trust, which is called a special trust for land tax purposes, doesn't get that threshold. So if you have a series of properties either in your own name or a family trust, you could end up paying upwards of $7,500 extra a year in land tax by doing that. So, you know, you've got to make sure that you look at all of these structures over what you're trying to do, which comes back to my first point around saying, what are you trying to do? And here's the life cycle of how you use those structures to their best of their advantage. So, you know, getting back to my point, it is a little bit more of an art than you should do this,
yeah.
and this. You've got to...
and again, the laws are constantly changing. So
absolutely.
If you're holding property for 20 or 30 years, you can't expect that you're going to have the perfect structure for all that time.
Absolutely. You know, a classic example now is with self-managed super. So I think we're going to talk about that a bit later on. But, you know, there are still a lot of structures that work, but you've got to put it to the client situation. There's no one-size-fits-all.
Yep, sounds good. Thrilling stuff, this again. Does it take you back, Tom?
Yeah. Well, it made me realise why I actually dropped out of accounting. Yeah, you do have to be more intelligent than an auctioneer.
Well, while we're talking about that, why don't you take us through your first property of the week?
Yes, I will. I'll take you through 17 Pleasant Avenue, Erskineville. And this property is going up for auction on the 30th of July. Brilliant designer property, and I know that even our guest today started his real estate holdings, I think. Was that your first purchase?
Yep, George Street, Erskineville.
George Street. Well, this is very close. It's Pleasant Avenue. I can give you a comparable sale here, Chris. There was a property that got traded there, 21 Pleasant Avenue in May this year, so it's two houses away, and that sold for $1,815,000. and this beautiful home, just nothing to do, exquisite. I can also tell you on Saturday, in Darlington, I sold a block of land for only 133 square metres for 1.3 million.
Wow.
133 square, very small block of land, and I can say that this property here, having an indication that the other one sold for 1.8 million, and looking at the home there on those shots there is nothing to do. I love Erskineville, Chris. Erskineville's a suburb that gets you to the eastern suburbs very quickly. It's got a train station. It's easy access to King Street, Newtown. I know that you've invested with your clients in the past there.
Yep. No, definitely, and certainly more affordable than the eastern suburbs.
Yeah.
So when you have comparable sales like that, is an auctioneer and a sales guy's dream to say, look, the exact same thing sold for 1.8 or near enough, and then that suddenly gives you a kickstart to get people in the mindset of paying those kind of numbers?
It does, because particularly in places like New South Wales, has got legislation where you can't actually give figures. Like previously, they've changed the quoting laws. Agents love having comparable sales, and the closer that you can get a comparable sale to the home, and this one here is 2 doors away. I mean, they're not identical homes, but 17 and 21, there's only one house that separates them. So comparable sales are good indicators for buyers, and their agents like them.
Sounds good. Well, let's jump into number 2.
Yeah, number 2, look, you're not going to get many comparables here, because this is... actually, I was thinking about you when I was talking to the agent from Collier's. This is a property that's built in partnership with the Ritz-Carlton Hotel Group. It's 250 Spencer Street, Melbourne, and we've got 1-bedroom apartments, 2-bedroom apartments, and 3-bedroom apartments. You are right in the heart of Melbourne. Walk to Etihad, walk to, the casino, everything at your doorstep. And this property is going to appeal to people that want to live have a hotel life. People that want to have all the facilities of a hotel, like use, the spa and the saunas and the restaurants. So what we're seeing is the Ritz-Carlton is coming back to Australia. It was originally in Australia. It left, and it is now making its entrance back into the country, and they're doing it with this development, which and there's 1,300 apartments in the first stage that is being sold by Collier's International.
So you can see that I'm used to a butler service and room service and stuff like that. And my room being cleaned every single time. Tell me, Tom.
You walking in and out of the lobby, and the people at the front door saying, "Welcome back, Mr. Gray." That's the picture I can see.
And that's different to now, because how?
Yeah. I'll pitch it to my wife after the show.
Okay.
Good to see you, Tom.
Thank
Good
you
to see you in person.